Hi there, it's November 20th. Stocks are in the midst of quite a rout. In fact, earlier today, the Dow Jones Index was down another 600 points. What are the factors driving this sell-off, and what can we expect to see from here? Is this the beginning of something more serious? Well, I want to delve into that with you today. I want to share some insights and some research to give you a greater sense of what's going on right now. First, I want to go back to September 26th. I did a video in which I shared a concern about the fact that the leadership in the stock market thus far had been concentrated in a small number of stocks, primarily in the technology sector. And I suggested that those stocks rolled over, they might take the rest of the market down with them, which is exactly what has played out. I've also spoken about the reality that historically, stocks tend to rally after the midterm elections have concluded. And we did get a nice bounce. Stocks rallied about 7%, but since then, that rally has faded, and now stocks are once again negative for the year here in the US. Let's take a look at some of the factors that I see driving this market sell-off right now and take a deeper dive.
These are the key drivers I see fueling the sell-off at this point. The first one, of course, is the ongoing trade war with China. And the fact is, at this point, there don't look to be significant signs of a resolution on the horizon. However, there has been some suggestion that the G20 summit taking place at the end of November could be a platform for Presidents Trump and Xi to work on some negotiations. We'll have to wait and see. The next one is the Federal Reserve and the fact they continue to raise interest rates. There are a lot of concerns from investors that the Fed is going to go too far in their efforts to thwart inflation and actually choke off the economy's growth, putting us on path towards the next recession. And while the U.S. economy continues to be on solid footing, the rest of the globe isn't doing so well. There are a lot of signs that the economy is slowing around us. Also, U.S. corporations' earnings have been quite robust, but corporate leaders are suggesting that their outlook for the rest of the year and beyond is not so robust. Investors are worrying that the best is behind us at this point in terms of corporate earnings. And the last one is that the UK's exit from the European Union is starting to show signs of having real economic impact.
Now, Legacy Wealth Partners, our investment approach is what we call evidence-based. We want to utilize data to guide our investment decisions to keep us disciplined rather than relying on our own intuition or gut feelings. I want to show you some of the research that we're using right now, what's telling us.
As I mentioned, a global slowdown is definitely taking place. And in fact, there's mounting evidence that would suggest a global recession may already be in the works. The folks at Ned Davis Research have done incredible quantitative work for the last 45 years, and they're one of the most highly regarded independent research shops in the world. Their recession probability model going back to 1970 has accurately predicted every recession that we've occurred from then until now. On this chart, you can see the gray vertical bars, which represent actual recessions that have occurred. And on top of that, we see this blue line zigzagging up and down, which traces variables that Ned Davis has identified to indicate rising or falling levels of recessionary risk. The critical level on the chart is the red horizontal line at 70. Every time that the model has gone above that 70 level, we've actually experienced the recession concurrently or shortly thereafter. Now, if you go all the way over to the far right to the present day, you can see that the level is currently above 70, hovering at about 80 right now, suggesting that there is a very high level of present global recession risk that may already be taking place. And while the global economy is slowing, possibly heading towards recession, we also want to address whether or not the U.S. economy will also be implicated in that recession or not. This is another tool developed by Ned Davis Research focusing on the U.S. economy and the probability of recession here. It goes back to 1979 and is a very similar methodology to the previous chart I showed you. The gray vertical bars represent actual recessions, whereas the blue line zigzagging up and down represents the recession risk. As you can see, the indicator over here on the bottom right is suggesting a very low level of recession probability at the moment. What we want to watch is whether this indicator increases, showing us a recession is on the horizon. Another tool that we use gives us about an 11-month lead time before recession begins when the indicator flashes its warning. And that is not happening at this point, guys. So what I can tell you is from what we see right now, a recession is probably at least another 12 months away. We're going to monitor the conditions as they develop, but that's what we see right now, and that's a little bit of good news. Understanding whether or not we are in a recession is critical to framing our view of what we might expect in terms of market decline. History tells us that those bear markets that occur during a recession have a greater magnitude of loss than those that occur outside of recessions. Here's another great study from Ned Davis Research tracing all of the bear market declines going all the way back to 1900. And at the bottom, we can see that the average non-recessionary decline for a bear market is slightly over 20%, whereas those that occur during recessions are closer to about 36%, a much greater magnitude of loss. Next, I want to share with you some technical analysis research. This, in fact, is a model that I've created looking at the S&P 500 index going all the way back to 1950, nearly 68 years. And this model helps us frame the market environment to tell us whether or not the trend is one we want to be participating in or rather protecting against. Now, on this chart, the yellow line that you see represents the market's movements over the last nearly 68 years. And the different color arrows that you see are plotted there by the software based on me programming the software to look for different variables that would suggest what kind of market environment we're likely to be in. When the software sees a confluence of variables that I've identified historically as being suggestive of an up market, it's going to plot a green arrow at that point. On the other hand, when the conditions change and there's a confluence of negative factors that I told the software to look for, it's going to plot a red arrow. Now, using this model historically would have helped us pretty successfully navigate through some important periods of time in market history. For example, I can show you on this chart back in early 1995, the indicator turned from negative to positive, and we began one of the most significant and lengthy bull markets in history, which was then followed by the tech stock market crash that began in late 2000 and took us down about 50% before the market recovered in about mid-2003. So this model would have helped us quite a bit during those periods of time. Fast forwarding again, we move forward in a positive market trending environment all the way up until a correction began in late 2007 and January of 2008. We've gotten another negative indicator taking this through and protecting against this bear market that occurred where the market dropped again about 50%. The recovery began around March of 2009, and we got a positive indicator here flashing around May of that year. Well, let's fast forward now to the present day. We've been in a positive, upwardly trending market environment, followed by green arrows showing us that existence all the way up until just now. November 9th, the model flashed the next warning signal. Now, what's important to understand is that no model, this or any, is going to be successful at predicting market moves 100% of the time. In testing this model, I've shown that it was successful about 70% of the time. There were in fact 26 red arrows that flashed a warning signal going all the way back to 1950, and about 70% of those were accurate. All I can tell you right now is that there's enough evidence suggesting both fundamentally and technically, according to this model, that the market has a good chance of going lower from here. We already addressed the fact that during corrections that occur outside of recessions, the maximum decline tops out about 20%. We're now about 10% below the market peak that we reached just a couple of months back in late September. On the other hand, there's another way the market could stop falling from here that I'm paying attention to quite closely. Right now, the S&P 500 is sitting around 2,640. And earlier this year, in January, we experienced a correction. The market stopped falling at a level of 2,530, which is about 4% lower from here. So that's my next stopping point. I'm looking to see if the market can stop falling at around that level and begin a recovery. Because if it doesn't, there's a good chance that we've got quite a bit ways to go lower from here. Finally, I want to conclude with some tips to help you successfully navigate the correction. First, it's important to follow a disciplined investment approach that makes adjustments based on evidence and not emotion. Because market risk is not constant, and we feel your portfolio shouldn't have to be either. Today, current evidence, both fundamental research and technical analysis, currently suggest that a more cautious approach is warranted. In fact, for our clients at Legacy Wealth Partners, in many cases, we've already made significant adjustments to rein in our clients' portfolio risk. But it's always important to know how much risk actually is in your portfolio to understand that and make sure it's appropriate for you and to not take more risk than you can financially afford. For all of our clients, we quantify their portfolio risk and make that number available for them to see at all times. But if you're not a client of ours and you want to learn more about the risk in your portfolio or more about our services, please go to our website, www.legacywp.com. And in fact, you can get a free portfolio risk assessment by clicking on the link that says Portfolio Risk Analysis. Thank you once again for taking the time to listen to me today.